Hello traders, Gary Wagner here. Approximately 1 o'clock in Honolulu, 7 o'clock in New York. It is Friday. Happy Aloha Friday, as we say on the island. It is the 18th day of June, 2021, and this is the weekend report of the gold forecast. To say that the FOMC meeting held this week was historical is an understatement. They started the clock for the first time. They showed that they vowed to have transparency and came through with some sort of a timeline. As nebulous as it might be, it's the first step to actually tapering back on their current monetary policy. That will be the main focus as to why the metals sold off, the stock market sold off on today's show, which begins now. Considering that gold was trading at $1,867 prior to the Fed statement released on Wednesday and Chairman Powell's press conference and closed today at $1,763.90, it has incurred in the last 3 days of trading over a $100 loss. Also, we have seen some major chart damage on a technical basis. It has broken through the 200-day, the 50-day, and 100-day moving average, and that was capped off by today's further drawdown, which was a response to James Bullard, president of the St. Louis Fed, saying that he expected one rate hike next year of the 61.8% Fibonacci retracement at 1769. It's a shorter data set, moving from the double bottom that occurred at the end of this March up until the top hit around $1,918 per ounce. While it was the dollar, which gained almost 2% in the last 3 days of trading, which accounted for a percentage of the drop in gold, silver, copper, platinum, and palladium, it by no means was the main market force moving the precious metals lower. That was selling pressure by market participants. We're looking at the dollar chart. You can see the dynamic move over the last 3 days, trading to from a low of 90.50 to its close today of 92.32. As I said, roughly a 2% gain. Considering the year-to-date gain is roughly 2.2%, it is accounting for almost all of the dollar strength this year in 3 single days of trading. To give you an idea of how the carnage this week occurred in gold, I am looking at a 30-minute candlestick chart. The arrows are simply pointing to the start of each trading day, the 16th prior to the release of the Fed statement. Market is steady as it waits for the statement in the press conference. As soon as that comes out, you can see an immediate drop. It drops to a low here, which comes in just at 1,800, just above that, actually spikes up a little bit, but by trading in New York on the 17th, had traded to a new low, the low that was achieved today, roughly at around $1,770. In fact, gold tried to stage a recovery today, trading close to $1,800 per ounce, with the high being $1,797.30, but then we had the St. Louis president of the Federal Reserve Bank come out, make a statement that we might see an interest rate hike as early as 2022, and that kind of put the final nail in the coffin for gold trading this week. The next question that gold investors and traders want answered is, was there any major chart damage that occurred this week during the fall? The simple answer is yes. There was tremendous technical chart damage because, as you can see, it went through the 200-day, the 50-day, and then finally today and yesterday we actually had closes below the 100-day moving average. But today we broke through, as I said in the price board, the 61.8% retracement of 1769.30, which brings us to a next plausible support level if we continue to see gold drop, and that occurs at around $1,730, the 78% Fibonacci retracement level. As we have been doing all week, we're using basically 2 different data sets to create 2 distinctly different Fibonacci retracement price points. The first one we showed you on the last chart was a shorter data set. This one begins at March of 2020, the lows of 1450, up to the record top. When we do that, we get a couple of very interesting harmonics. And the most important harmonic is, whereas we had a very important 61% retracement in the shorter data set, it is the 50% retracement in this longer data set that we broke through today in trading. These were two logical places to look for potential support, although they did not occur. Now, if we look at this chart, it shows us the next level to look at for price support should gold continue to fall actually occurs under 1700 at 1693.70. Traders, we will remain neutral with no active trades in gold. We are still waiting for the dust to settle. Silver certainly did not escape the selling pressure, closing just above its 200-day moving average, but considering that it was trading at a high near $28 on Wednesday and closed today at $25.84, we've seen a definitive decline, but it is palladium that was hardest hit over the last 3 days due to the thinness of that precious metal in terms of trading, as well as the fact that it is the most expensive precious metal available. It sold off to the tune of over $300 in losses in a single day yesterday. You can see that large red candle here, and closed just below its 200-day moving average today. While silver did not close below the 200-day moving average, it was right at that price point yesterday, and in fact closed a little bit higher compared to the close of Thursday, but still off by 11 cents at $25.84. The logical point to look for support should silver continue to fall is $25.10. That's based upon the 61.8% fib retracement, which goes from the lows at $21.50 up to the highs of $30. Lastly, the industrial metal copper has had a tremendous price decline over the last 3 days of trading, losing tremendous ground from about $4.50 per pound just at the beginning of this week to $4.12 per pound. The reason the selling pressure began earlier than the precious metals is that China announced earlier this week that it would begin to release copper from its national stockpiles in attempts to stave off the record high pricing of copper. China is still the single largest producer of copper, but the single greatest user and a net importer of copper products. So it is within their best interests that copper prices go lower, since their infrastructure program will require so much more copper. As history has taught us, intervention by a country to support its currency or a commodity can only slow down the natural course of where it belongs, which means that eventually the price of a commodity or the rate of a currency will move to naturally where it belongs to be based upon supply and demand. In the case of currencies, of course, interest rates and returns, but a country cannot artificially support something like copper forever. And it is for that reason that I believe we will still see $5 copper by the end of the year. The question is, how deep will this current retracement take copper pricing before it finds a bottom? As mentioned during the price board announcements in copper, I do believe there's going to be a tremendous opportunity for the industrial metal. However, where will that occur in terms of pricing? Copper, unlike the other precious metals, did not even come close to breaking through the 200-day moving average, and that's because it has been on such a roll, trading from these lows at $2 a pound back in March of last year up to these record highs at approximately $4.87 per pound. So long-term studies indicate that it probably could go as low as $3.75 per pound. That is the 38.2% fib retracement. However, if you look, you can see that we had this compression triangle that came in really at the beginning of the year. And so what we have is a base that really has formed right around $4 of support. It is not based on Fibonacci, but rather a series of lows that occurred at the beginning of the year right in here. And so for that reason, we want to take a serious look, if it continues to drop, how it reacts when in fact it trades as low as $4 per pound. And that's only about 12 cents from here if we see a kick up or a further decline. Of course, if we see a further decline, our target is going to be $3.75. If we do not, this might be the proper point to enter it. It all has to do with China and how much copper they're releasing, along with the continued numbers of supply and demand needs. Because realize, Biden is still trying to pass his infrastructure bill, and the Clean Energy Act combined with infrastructure will require tremendous amounts of copper in the United States. China is fully committed to their infrastructure program, which will do the same, require huge amounts of copper to fulfill the needs of those programs. Therefore, we are on hold in copper, but we are significantly bullish when we get the right price. This has been Gary Wagner wishing you, as always, good trading. Have a great weekend, and Father's Day, we'll talk to you on Monday for the next daily update and review. Bye-bye.